Escrow exists because big transactions require trust before everyone has fully performed. In real estate, the buyer does not want to hand money directly to the seller too early, and the seller does not want to transfer ownership without confidence that payment is real. Escrow means a neutral third party holds money, documents, or both until agreed conditions are met. The escrow holder follows written instructions. The point is to reduce risk during the gap between agreement and closing. Earnest money can make the surface story look simpler than the real situation. In a home purchase, earnest money is often placed into escrow after the offer is accepted. That deposit shows the buyer is serious, but it is not simply handed to the seller. It is held while inspections, financing, title work, and other steps move forward. Written escrow instructions is often the detail that separates a quick reaction from a wiser response. Escrow protects both sides. If the buyer meets the contract terms, the deposit can be applied at closing. If the buyer breaks the contract without a valid reason, the seller may have a claim to the deposit depending on the agreement. Inspection deadlines shapes what should be checked next. The escrow holder is not supposed to take sides. Their role is administrative and rule-based. They collect documents, follow instructions, coordinate funds, and release money only when the conditions allow it. Financing contingencies turns the idea into something practical rather than only theoretical. Escrow instructions matter because they decide what must happen before money moves. A vague understanding is not enough. The written contract, deadlines, contingencies, and closing instructions control the process. Title problems deserves attention before the choice becomes harder to reverse. Inspection contingencies can affect escrow. If the inspection reveals a major issue and the buyer cancels within the allowed period, the deposit may be returned. If the buyer misses the deadline, the answer may change. Recording the transfer can quietly move the cost from the present moment into the future. Financing contingencies also matter. If the buyer cannot obtain a loan despite following the contract requirements, escrow may handle the deposit differently than if the buyer simply changes their mind. Mortgage escrow accounts helps explain why the obvious answer may not be the best answer. Title problems can delay escrow. If ownership records, liens, unpaid taxes, or boundary issues appear, the closing may not proceed until they are resolved. Escrow helps coordinate the documents needed to clear those problems. Tax and insurance payments gives the situation its real-world weight. At closing, escrow collects the buyer's funds, lender funds, signed documents, and seller documents. Once all conditions are satisfied, the money is distributed and the transfer is recorded according to local rules. Escrow shortages is worth checking when the first explanation feels too neat. Escrow can also refer to mortgage escrow accounts. In that case, the lender collects part of the borrower's monthly payment for property taxes and insurance, then pays those bills when due. Escrow refunds can decide whether the problem stays small or grows into a pattern. A mortgage escrow account can protect the lender and simplify budgeting for the homeowner. Instead of facing a large tax or insurance bill separately, the homeowner pays smaller amounts through the monthly mortgage payment. Wire fraud keeps the analysis tied to behavior, money, timing, risk, or trust. Escrow shortages can happen when taxes or insurance rise. If the account does not collect enough, the lender may increase the monthly payment or ask the homeowner to cover the shortage. Closing documents belongs in the decision because it changes what action would help. Escrow refunds can happen too. If the account collects more than needed, the borrower may receive money back or see an adjustment, depending on rules and lender practices. Who pays escrow fees becomes more reliable when it appears more than once. A common mistake is assuming escrow makes a deal automatically safe. Escrow reduces certain risks, but it does not replace reading the contract, meeting deadlines, checking title, or understanding contingencies. Deposit disputes should be checked before accepting the most comfortable explanation. Another mistake is ignoring communication from the escrow company or lender. Missing a document, wire instruction, identification requirement, or signature can delay closing even when the buyer and seller agree on the deal. Buyer and seller protection needs to be connected with the actual consequence. Wire fraud is a real risk in real estate escrow. Buyers should verify wiring instructions through trusted channels before sending money. A fake email that looks official can redirect funds to a criminal account. Conditions before release keeps the topic grounded in daily life. Escrow fees are part of the transaction cost. Who pays them depends on local custom and the purchase agreement. The amount should be reviewed with other closing costs before the buyer reaches the final signing table. Communication with escrow can be found in behavior, documents, timing, or repeated choices. Escrow matters because it turns trust into a controlled process. Money and documents move only when conditions are satisfied, which gives both sides a safer path through a complicated transaction. Deadline control makes the issue easier to name in plain words. The best way to handle escrow is to read the instructions, respect deadlines, verify payment details, and ask questions before signing. Escrow is not just a holding account, it is the rulebook for when the deal can safely close. The safest buyers and sellers treat escrow messages, deadlines, and wiring details as part of the deal, not as admin work to rush through. Escrow is useful when trust alone is not enough. A buyer may not want to hand money directly to a seller before ownership transfers. A seller may not want to transfer ownership before payment is secure. Escrow holds both sides in place until the agreed steps are complete. Escrow also reduces emotional pressure during negotiation. Without a neutral holder, one side may feel pushed to trust promises too early. With escrow, the money and documents move according to the written process. That structure helps keep the transaction from depending only on verbal reassurance. In real estate, escrow can involve deposits, loan documents, title checks, inspection deadlines, and closing instructions. The process may feel slow, but the delay exists to make sure money and ownership move in the correct order. In a property purchase, escrow can also coordinate many moving parts at once. The lender, title company, buyer, seller, inspectors, and agents may all have deadlines. Escrow does not make those steps simple, but it gives them a common place to be tracked before closing. Escrow does not remove every dispute. If a buyer misses a deadline or a seller fails to meet a condition, the agreement decides what happens next. That is why contract dates, contingencies, and written instructions matter. The buyer and seller should also know who can authorize release of funds. Escrow is neutral, but it follows written instructions. When those instructions are unclear, delays can appear even when both sides believe the deal should be simple. Escrow is best understood as a controlled pause. It protects the transaction while both sides prove they are ready to complete it. When the conditions are met, money, documents, and ownership can move with far less confusion.